Welcome to the Dev Journal. Today, we explore a fundamental transformation in how machines interact with our world. We are moving past simple chat interfaces and into the era of autonomous agents that can think and act independently. This shift is forcing a massive rethink of the financial foundations for giants like Alphabet and NVIDIA. Google is pushing the boundaries of real-time interaction with their latest release of Gemini 3.1 Flash Live, focusing on multimodal voice capabilities. Meanwhile, Oracle is embedding these agentic workflows directly into their enterprise resource planning applications. It is a race to see who can automate the most complex business processes first and most effectively.
Sloan, the hardware layer, is where the friction really shows up in the data. I am looking closely at NVIDIA, where an oversold relative strength index is colliding with the upcoming Graphics Processing Unit Technology Conference event Catalyst. We have regulatory headwinds meeting massive technical demand, and the 5-day outlook suggests the market is reaching a critical breaking point.
It sounds like the volatility is just beginning for the chip makers. We will break down those technical signals alongside the legal pressures currently weighing on Alphabet. There is a lot to unpack as the industry pivots toward true machine autonomy. First, we need to examine how Google is trying to bridge the gap between speech and action. Google is fundamentally changing the rhythm of human-machine interaction by eliminating the traditional stack of voice activity detection and speech-to-text. This new native audio processing allows the model to interpret subtle acoustic nuances like pitch and pace. It enables a natural barge in functionality that finally makes artificial intelligence conversations feel human. Beyond just sounding more human, these agents are proving they can execute complex tasks with a high degree of precision. On the complex function bench audio benchmark, Gemini 3.1 Flash Live achieved a score of 90.8%. This indicates a remarkable ability to handle multi-step function, calling directly from an audio stream. Developers now have more control over the user experience through a new thinking level parameter that balances speed with reasoning depth. By choosing between minimal and high settings, companies can tailor the response time to the specific complexity of the job. It ensures the interface remains responsive, whether the agent is performing a simple or difficult task. While these interface improvements bring us closer to a truly seamless digital assistant, the underlying engineering requirements for such low latency performance are quite rigorous. Vance, how does the actual data streaming architecture hold up when we move from simple voice interactions to a full multimodal environment involving both audio and video frames?
The technical plumbing relies on WebSocket secure connections to stream 16-bit pulse code modulation audio at 16 kHz. While the audio side is impressive, the Multimodal Live Application Programming Interface only supports video at 1 frame per second. This suggests that the visual side of the reasoning engine is still lagging far behind the auditory processing. Real-world reliability also remains a significant hurdle, despite the high scores in controlled environments. On the Audio Multi-Challenge, the model only managed a score of 36.1% when faced with environmental noise like traffic. This indicates that the system still struggles to consistently discern speech from the chaotic sounds of a typical outdoor setting. That thinking level parameter you mentioned is essentially a toggle for the inherent trade-off between time to first token and reasoning quality. Setting the model to high reasoning will almost certainly destroy the real-time feeling that the live application programming interface is trying to achieve. It is a necessary but difficult compromise for high-stakes enterprise workloads. We should pivot from the low-latency interface layer to the autonomous execution layer, where these agents will actually perform enterprise work. The next logical step for this technology is deep integration into business software. This brings us to how Oracle is attempting to weave these agentic capabilities directly into their massive resource planning ecosystem.
Oracle is pivoting away from simple digital assistants toward a future where software actually does the heavy lifting. By launching their Fusion agentic applications, they are targeting a massive $225 billion in sales by the year 2030. This move represents a fundamental shift in how large enterprises will approach their core business operations. These new applications are designed to tackle the massive operational overhead that plagues modern finance and supply chain departments. Instead of just offering suggestions, these agents can autonomously reconcile complex transactions and handle multi-step procurement processes. It is a bold attempt to solve the chronic talent gaps currently facing many global organizations. The goal here is to move past the surface-level adoption we have seen with basic chatbots. As industry analysts at Retail Banker International have noted, failing to deeply integrate these tools often leads to fragmented systems and poor returns. Oracle is betting that by embedding intelligence directly into the workflow, they can finally deliver real return on investment.
I worry that removing the human safety net from high-stakes procurement and financial steps will create more problems than it solves. When you transition from a recommendation engine to an autonomous operator within a complex enterprise resource planning framework, the technical burden shifts entirely. We are no longer just looking for speed, but for absolute precision and verifiable logic. For these systems to meet strict regulatory accountability standards, they must provide robust explainability and clear audit trails for every decision. Without these features, no responsible chief financial officer is going to let an algorithm manage their capital flows. The industry is currently facing a massive supervision gap that could easily lead to expensive and public compliance failures. Even in banking sectors where cloud contact centers are using similar technology, the risk of over-automation remains high. While Oracle claims these agents will fill talent gaps, managing an autonomous fleet requires a different kind of expertise. We might just be swapping manual labor for the even more difficult task of debugging black box business logic. High-stakes human resources and finance decisions simply cannot be fully automated, yet without risking significant organizational damage. The promise of filling vacancies with silicon instead of staff overlooks the nuanced judgment required for sensitive corporate actions. We need to be very careful about assuming that a large language model can navigate the messy reality of human office politics.
We are essentially watching the enterprise world try to map digital workflows to physical business outcomes with varying degrees of success. It is a massive undertaking, but perhaps it is minor compared to the challenge of mapping the human mind itself. We are moving from automating business workflows to the ultimate multimodal challenge of decoding the human brain. Meta is attempting that very feat with their new version 2 of the Tri-Modal. By combining large language model Meta artificial intelligence, 3.2-3 billion for text with video joint embedding predictive architecture 2 and Wave to vector bidirectional encoder representations from Transformers 2.0 for audio. They have created a powerful Tri-Modal foundation. The sheer magnitude of this research is unprecedented in the private sector. Utilizing over 451.6 hours of functional magnetic resonance imaging data. With 720 subjects, the model was evaluated against an additional 1,117.7 hours of data, representing a massive leap in neuroscientific data sets. What truly excites me is how this could revolutionize personalized medicine through its remarkable efficiency in fine-tuning, achieving a fourfold improvement over traditional linear models with just 1 hour of new subject data, suggests that we are nearing a point where clinical tools could provide real-time, highly accurate brain mapping for individual patients in need. I wonder if the architecture itself is actually robust enough to account for the physical lag inherent in biological signals versus the speed of the digital inputs. Vance, how does the system manage to synchronize the fast pace of video and audio with the much slower changes in blood flow that the scanners actually detect?
They handle that biological latency by using a temporal transformer with 8 layers and 8 attention heads to aggregate multimodal embeddings across a 100-second window. This specific window length is critical because functional magnetic resonance imaging data tracks the hemodynamic response, which is notoriously sluggish compared to the millisecond-level processing of our auditory and visual systems. The results on zero-shot generalization are actually quite staggering, reaching a group correlation near 0.4 on the Human Connectome Project 7 Tesla dataset. That effectively doubles the predictive accuracy found in the recordings of a median human subject, proving that their internal representations of language and motion are emerging correctly without any specific task-based training. It is also worth noting that the system demonstrates clear log-linear scaling laws, where predictive power increases steadily as the volume of training data grows. This suggests that we have not yet hit a ceiling on how well these models can simulate the primary auditory, visual, and default mode networks of the human brain as more data flows in. However, the cost of maintaining such sophisticated research operations is astronomical, often overshadowed by the legal and regulatory pressures facing the tech giants. We need to transition from these high-level research and development breakthroughs to the brutal financial reality of the companies building the infrastructure for them, specifically looking at the upcoming weeks for Alphabet Incorporated. Alphabet is currently showing a relative strength index of 21.95, which puts it deep into oversold territory following that 7% weekly drop. This volatility was triggered by a legal verdict in an addiction case, but the technical indicators suggest the market might be reacting more to the underlying numbers. We have to look at the $91.45 billion in capital expenditures weighing on the balance sheet. While analysts hope for $2.5 billion in high-margin tensor processing unit revenue from Anthropic by 2026, that is a long runway to justify this level of spending. To keep pace with Microsoft and Amazon, they are finalizing $5 billion in financing for a massive Texas artificial intelligence data hub. This facility is dedicated almost entirely to Anthropic, highlighting how crucial it is for Alphabet to lock in these compute workloads to maintain their massive infrastructure scale in the long run.
How do we reconcile those heavy costs with the fact that fundamental performance remains exceptionally robust, boasting 32% year-over-year earnings growth? A 32.81% net margin suggests the recent 7% price dip is likely a classic overreaction rather than a shift in their trajectory. Their $32 billion all-cash acquisition of Wiz is the largest in the history of the company and a major power move. It signals that Google is no longer content playing second fiddle to Azure and Amazon Web Services when it comes to enterprise security and cloud infrastructure for the modern era. Wells Fargo has already responded with an upgraded price target of $397, forecasting a 41% upside from current levels, with a mean reversion rally potentially targeting $376.75 before the April earnings report. The institutional appetite for this recovery looks strong. The combination of record-breaking acquisitions and high-margin silicon revenue suggests a company that is aggressively fortifying its ecosystem. While the legal headlines create temporary noise, the sheer financial power of their 59.65% gross margin provides a massive cushion against any near-term market turbulence.
Since you mentioned custom silicon and cloud strategy, we should look at how that compares to the broader hardware market. This leads us directly to the dominance and volatility of NVIDIA, where their own oversold indicators are meeting a massive catalyst in the upcoming graphics technology conference event amidst new regulation. Looking at the technical dashboard for NVIDIA, we are seeing a 14-day relative strength index that has dipped to 31.42. This puts the stock at a current price of $167.52, suggesting a classic oversold condition that often precedes a potential technical bounce. However, the market risk is underscored by a high beta of 2.38 and significant recent insider selling, totaling $253 million. Even with a stellar net margin of 55.60%, these signals suggest that some internal stakeholders are bracing for significant volatility ahead. Beyond the numbers, the Commerce Department export license pauses and a revived class action lawsuit represent genuine structural risks for the company, while their return on equity stands at an elite 101.48%. These legal hurdles could fundamentally shift the growth narrative regardless of the underlying fundamentals. Does the sheer financial scale of their operations provide enough of a safety net to ignore those brewing regulatory storms? Their $4.07 trillion market capitalization is a massive figure, but I wonder if the sheer weight of expectation is starting to outpace the reality of actual hardware delivery.
The scale you mentioned is precisely what makes their position so resilient, especially with trailing 12-month revenue reaching $215.94 billion. That 65.47% year-over-year increase proves that demand for high-performance infrastructure remains the primary engine of this modern economy. Anticipation is building for the upcoming Graphics Technology Conference, where Jensen Huang will provide updates on the OpenClaw artificial intelligence platform. Many analysts are projecting a 5% price increase following that keynote, viewing the current price dip as a rare entry point before the next massive wave of innovation. With $96.68 billion in free cash flow, they have the capital to navigate almost any legal or regulatory challenge that comes their way. A gross margin of 71.07% reflects a level of operational efficiency that most industrial giants can only dream of. We have to consider how this hardware dominance shapes the entire ecosystem as we move from the hardware suppliers to the software platforms struggling to optimize their own margins in the artificial intelligence era. That brings us to Unity Software and their attempt to turn a corner with a new strategic overhaul. Unity is finally trimming the fat by sunsetting the ironSource advertising network and divesting their supersonic game publishing division to rediscover their core identity. This pivot allows the organization to double down on their vector segment, which is currently seeing a massive 70% growth rate as they move away from being a sprawling conglomerate. The financial markets are responding to this clarity with preliminary first quarter guidance for 2026 showing adjusted earnings before interest, taxes, depreciation, and amortization between $130 million and $135 million. That represents a 58% increase year over year and suggests the turnaround is gaining real momentum. By focusing on strategic revenue, which is projected to jump 48%, when we exclude those divested units, they are proving that there is still significant hunger for their development tools. This renewed focus on the commerce platform is further bolstered by a fresh partnership with Epic Games to drive wider enterprise adoption. Investors clearly like the direction because we saw a 13% single-day rally, taking the stock to $19.45 while moving away from oversold territory. Vance, do you think this technical momentum is enough to bridge the massive gap between their impressive gross margins and their actual bottom line?
It is hard to ignore a 74.17% gross margin, but the 96 percentage point gap down to a negative 21.78% net margin is a structural alarm bell. They are effectively burning through every dollar of profit on operational friction and heavy overhead before it ever reaches shareholders. Even with that recent price surge, we are still looking at a trailing 12-month net loss of $402.76 million, which creates a very narrow window for error. The company carries a high beta of 2.18, meaning investors should prepare for significant turbulence regardless of the optimistic analyst targets. While the 14-day relative strength index of 39.13 showed the stock was heavily oversold before the rally reaching that $32 and 33-cent price target requires flawless execution. The market is pricing in a recovery, but the underlying architecture of their business still lacks the efficiency required for long-term stability.
That tension between high gross margins and operational reality reflects the broader challenge for the entire sector as we transition into the era of agentic artificial intelligence. Delivering these advanced technical capabilities is a necessity, but the financial pressure to convert that innovation into actual profit remains the ultimate test for every major enterprise.
Between Google launching Gemini 3.1 Flash Live for multimodal voice and Oracle deploying agentic applications for enterprise resource planning, workflows, the shift toward autonomous systems is undeniable. We are moving beyond simple chat interfaces into a world where software acts on our behalf with real-time speed and high reliability.
Vance is highlighting a trend where agentic artificial intelligence becomes more than just a software update, because it represents a fundamental change in how we interact with technology. Whether it is through multimodal voice or automated business logic, these systems require massive infrastructure and clear financial models to survive the current market. As we watch companies like Alphabet and NVIDIA navigate this complex landscape, remember that the real story is the human impact of these autonomous agents. Thank you for spending your time with us today as we explore the intersection of technical innovation and economic reality. We will return tomorrow with more insights on the development journal.